Welcome to Tax Guide on Rental Properties. In this session, we will cover an overview of rental properties, assessable rental income, allowable rental expenses, and how to apportion those expenses. We will also touch upon PAYG installments and review how this all comes together. Please remember that this information is for teaching purposes and caution must be used due to potential legislative changes. Any income received from rent is assessable. As a taxpayer, you can claim a deduction under Section 8(1) for expenses incurred to earn that rental income, as long as the property is rented or available for rent. Capital or private expenses aren't deductible under this section, though you may claim some capital costs through depreciation or capital works. Remember, Australian rental properties are declared at Item 21, while foreign properties go to Item 20, except for foreign property interest which is claimed at Item D15. Rental properties generally fall into residential, commercial, or commercial residential categories. Residential premises, intended for residential accommodation, like houses and units, but typically exclude caravans or houseboats. When it comes to GST, residential rent is input taxed, meaning you don't charge GST on rent and cannot claim GST credits for expenses, even if you are registered for GST for another enterprise. Conversely, commercial properties like shops are subject to GST. Commercial residential properties, like hotels, are subject to GST for stays under 28 days, but concessional rules apply for longer stays. Notably, an individual apartment leased to a management company within a commercial complex is still treated as a residential property for GST purposes. How you own the property dictates how income and expenses are split. For joint owners, income and expenses must be shared strictly according to their legal interest, whether as joint tenants holding equal shares, or tenants in common holding specified percentages. Private agreements to split profits differently have no effect for tax purposes unless a formal partnership at general law exists. The only exception is if one owner solely borrows money to acquire their specific interest, they claim that interest deduction. A partnership at general law only exists if owners are carrying on a rental property business. This requires significant scale, active management, and time invested, in which case profits and losses are split based on the partnership agreement. Rental income is assessable when it is received, which includes advanced rent, late rent, and payments collected by an agent on your behalf during the financial year. It also includes retained bond money, insurance payouts for lost rent, and reimbursements from tenants for items like water consumption. Unpaid rent is not declared until received. If you have a boarder under a domestic, non-commercial arrangement, there are no tax consequences, but if they pay commercial rent, the income is assessable and related expenses apportioned. Finally, if expenses exceed income, the property is negatively geared. These losses offset your other assessable income, which can generate a tax refund or allow you to reduce your employer withholding via a PAYG withholding variation. Moving on to expenses. You can claim deductions from the date the property is rented or genuinely available for rent. To be genuinely available, it must be advertised broadly without unreasonable restrictions. You must apportion expenses if the property is only rented for part of the year, only partially used to earn rent, or rented below market value. Short vacancies for repairs between tenants do not require apportionment. Important to note, since the 1st of July 2019, holding costs for vacant land are generally not deductible unless you fall into a specific exception, like carrying on a business. If a property ceases to be rented, repairs to restore it to its pre-rental condition remain deductible, provided they are incurred in the same financial year. We group rental expenses into three categories. First, non-deductible expenses include acquisition and disposal costs, initial repairs, and travel expenses for residential properties post-July 2017. Second, immediate deductions include ongoing costs like council rates, insurance, interest, and repairs. Third, expenses claimed over a number of years include borrowing expenses, capital works, and depreciation. Remember, while acquisition costs like purchase price and stamp duty cannot be claimed against rental income, they form part of the cost base for capital gains tax, reducing your capital gain when you eventually sell. The only exception to this is properties in the ACT under a 99-year Crown lease, where stamp duty is actually deductible. Let's look closer at immediate deductions. Advertising for tenants is deductible, but advertising to sell the property is a capital cost. Body corporate payments are deductible for general administration, but special levies for capital works are not. Standard insurance is claimable, but mortgage protection insurance is only deductible if the policy makes loan repayments during unemployment or illness, not if it pays a lump sum upon death. Rates and land taxes are fully deductible, but ensure you apportion them based on settlement statements when buying or selling. Legal expenses are deductible if used to evict a tenant or recover rent, but not for buying or defending property title. Lastly, prepaid expenses can be claimed immediately if they are under $1,000 or cover a period of 12 months or less ending by the next 30th of June. Interest is often the largest deduction, but the golden rule is that the purpose of the borrowed funds must be for producing income. The security used for the loan is irrelevant. If you use a loan for both a rental property and a private asset, you must apportion the interest. If you have a redraw facility and pull out cash for a private purpose, you must recalculate your deductible percentage immediately. Line of credit facilities with mixed use require complex daily or monthly calculations based on outstanding balances. Penalty interest or break fees for refinancing or selling are generally deductible as they relate to releasing a recurring interest liability or discharging the mortgage. However, be wary of split loans, designed to rapidly pay down a private home while letting rental interest compound. The ATO applies anti-avoidance rules to deny the extra interest generated by this setup. Distinguishing between a repair and an improvement is critical. A repair restores a subsidiary part of the property to its original condition, like fixing a broken window or replacing a few damaged fence palings. An improvement enhances the property's value or replaces an entire structure, like putting on a brand new roof. These are capital expenses. Importantly, initial repairs, fixing damage that was there when you bought the property, are always capital, even if you didn't know about the damage. In special cases, like removing a dilapidated asbestos shed, the cost might be fully deductible as an environmental protection activity. Also, if you hire a tradesperson for repairs, ensure they provide an ABN. If they don't, and no exemptions apply, you must withhold 47% tax. Failing to do so means you cannot claim the repair as a tax deduction. Since the 1st of July 2017, travel expenses to inspect or maintain residential rental properties are completely non-deductible and cannot even be added to the CGT cost base. Travel for commercial properties is still deductible, but must be apportioned if mixed with a private holiday. If driving to a commercial property, the standard cents per kilometer method can be used, capped at 5,000 kilometers total across all claims. For minor property assets, you can claim an immediate deduction for depreciating assets costing $300 or less. However, this does not apply if the asset is part of a set that costs more than $300 in total, or if you buy multiple identical items that exceed the threshold. Finally, some expenses are claimed over several years. Borrowing expenses, like loan establishment fees and lender's mortgage insurance, are claimed over 5 years or the life of the loan, whichever is shorter. If you pay the loan out early, you claim the remaining balance in that year. Capital works deductions cover the structural costs of buildings, extensions, or alterations. For most residential properties built after 1987, this is claimed at 2.5% per year over 40 years using the prime cost method, starting from the date construction was completed. That brings us to the end of our session on rental properties. To wrap up, always remember the importance of accurate income reporting, correctly categorizing your repairs versus capital improvements, and keeping flawless records for mixed-purpose loans. Thank you so much for your time and active participation today.